Muy buenos días, bienvenidos a esta sesión, que es una sesión particularmente importante porque lo que va a tratar es de perfilar cómo es el orden macroeconómico, las tendencias macro para la minería, para el futuro, para estos años, y tenemos un panel excepcional para poder delinear ello. Tenemos en primer lugar a la flamante ministra de Economía, Claudia Cooper, quien nos va a pintar justamente el marco macro y qué implica eso para la minería. Y también contamos con el señor Dan Kerner, director para América Latina de Eurasia Group. Ustedes tienen en toda la carpeta que les han entregado la descripción completa, solo voy a ir al título principal. Está el señor Richard Wilson, Chairman of Metals de Wood Mackenzie Unlimited del Reino Unido, y el señor John Willett, Managing Director de Investment Banking Raymond James Limited de Canadá. Así que vamos directamente al tema para una sesión sumamente importante y vamos a conversar, a empezar con el señor Dan Kerner, quien es director para América Latina de Eurasia Group. Dan, adelante, por favor.
Okay.
No, la lista va a ir al final.
Okay. Well, thank you, everyone. We'll have the presentation soon. Oh, there you go. So first of all, thank you for inviting me. It's a pleasure to be here. And my intent here is to talk a little bit about the geopolitical situation today. There's lots of things that are happening in the media. You see North Korea, Iran, China, and it's, I think, important to try to make sense of it. So I'll talk more about how we're thinking about the new geopolitical order, and then focus a little bit on the implications for Latin America, for the mining sector, and for Peru. But just to start, I would say that if I had to leave you with two key ideas, I would say the first one is that the geopolitical situation is an absolute mess. And maybe I could stop at that and leave you with that, but I won't. I have to stay here for another 20 minutes and walk you through why this is the case. But it is a mess. And the second is that it matters. And it matters not just because it matters in the normal way that it's always mattered, because of possibilities of war, of nuclear developments, but it matters because geopolitics are having an increasingly important effect on the world economy, on markets, and on different countries. And I think this is particularly important at this moment, because when we look at the world economy, what we see is that we're finally getting out of the woods. The US economy seems to be growing robustly, as a US economy can. Europe is doing better. Japan is doing better. In Latin America, also we're doing better. Not as good as we used to do, but we're all doing better. And when you look at it, the economic picture looks better. It's really the political picture that is looking much more challenging. And what happens with the politics can very much put this economic recovery at risk, with very important implications for the countries that are growing and for markets in particular. So let me focus then a little bit on why I think that geopolitics is a mess, and explore a little bit what the impacts are. The reason why geopolitics is a mess is because we are experiencing a big change in the way the world functions. The world order that was established after the Second World War, with the US as the big provider of public goods, and really the provider of the institutions that allowed trade to function, security cooperation, the economy to grow, and a lot of the forces that led us to where we are today in terms of increasing trade, globalization, travel, technological development, that is changing. We're moving towards a new world. That is nothing new. It's something that's been happening very slowly at the macro level, with the relative decline of the US, and thus its increasing incapacity to be the provider of those public goods, even though it still is, and it's still the main leader of at least world cooperation, and the relative rise of other countries, mostly China, that has no interest in doing that. So over the past several years, we've been moving towards what we call this G0 world, a world in which cooperation is much harder, where to solve global problems is increasingly difficult, and where instability is going to be more of a norm. At the micro level as well, we've seen some of these changes, and we've seen that especially manifested in elections in Europe and in the US, with growing voter discontent and anger towards precisely the forces that got us here. globalization, trade expansion, immigration. Those things have changed the world, but all these trends have accelerated dramatically since last November and since February, when President Donald Trump was elected and then inaugurated in the US. And the reason for that is that now we have someone in the White House that actually believes that that world order needs to be changed. What Trump thinks is that America's foreign policy and domestic policy need to be driven by an America First idea. America First is not isolationism, is not to turn around and turn its back to the US economy, but it is an idea based on an interpretation that that world order is not beneficial for the US, that every country has been taking advantage from the US, that the US needs to follow a much more transactional approach, selective approach, and needs to change these institutions. So essentially what we have now is that the US has become the main source of political risk. While before it was the biggest source of stability, today it's the main source of risk and uncertainty. And that is a big change, and that has potentially enormous implications. When you think about how this can manifest itself, I think you can think about two levels. On the one hand, what happens domestically in the US. And obviously that's of interest for voters in the US, but that's also of interest for everyone else and for markets. Domestically, what could happen in the US is much more limited than people anticipate. The truth is that in spite of what Trump originally thought, a president in the US is actually a fairly weak president. They have to negotiate with Congress, they have to deal with undisciplined parties, they have to deal with judiciaries, with a number of interest groups. It's not a surprise that 8 months into his presidency, when we were supposed to be tired of winning in Washington, where I live, we haven't really had any major change. There was a lot of expectations about what could change, some negative and some positive. The positive was that there could be a big fiscal stimulus, big infrastructure spending, a massive tax reform that would boost economic growth in the US, strengthen the dollar. Markets rose on that. And now people are realizing not that much is going to happen domestically. We think there's going to be some tax reform, probably next year. The chances are still that it will happen, but it's going to be minor. But forget about fiscal expansion, forget about infrastructure. And that matters a lot for the US economy and for the global economy. On other things domestically, the entertainment is going to be massive. It's going to be an issue of reading Twitter every day and trying to figure out what things are going to happen. But probably what can be achieved is very limited. There's lots of talk of impeachment in the US. A lot of people really want that, but it's probably not going to happen unless Trump loses the support of the Republican Party, which he isn't, of the Republican base, which he still hasn't, and he probably won't. And unless there is very clear evidence that he colluded with the Russians, this is something that's going to last for 3 years. But foreign policy is a little bit of a different animal. In foreign policy, a president does have a lot of power, and Trump seems to have much stronger ideas in terms of what he wants to achieve, which essentially is to take the US out of a lot of the alliances that were built since the Second World War. A lot of people in his cabinet don't like that. Most people in Washington don't like that. His base really likes that. A lot of people in the US really want it, and he wants to do it. These trends have been, to some extent, I would say, contained by one important phenomenon that has happened in the administration, which is the rise of the generals. If you look at Trump's cabinet, today the most important figures are his national security advisors. McMaster, Kelly, and others. These are people Trump respects for a number of reasons. And those are people that do believe in alliances, that do understand the complications and nuances of foreign policy, and that will constrain how much he can do. But the truth of the matter is we have a structurally more complicated world with an administration that doesn't have a clear plan to do it and would prefer to have a different approach, with one that relies more on multilateral interventions. I would say that the main risks that you'll have from a foreign policy perspective, and these are all risks that have important potential implications for markets and thus for the mining sector. Number one is North Korea. In North Korea, we have a rogue government that wants to have nuclear weapons and wants to have the capability of sending those weapons to the US. The US clearly is very concerned about that. They really don't want that. Japan doesn't want that. South Korea doesn't want that. I would say most people don't want that. But there's not much that they can do to stop it. So more likely than not, we're going to have to get used to deal with a nuclear North Korea. The military option that Trump keeps talking about is very unlikely, given that it will have disastrous consequences on the world, but more particularly in South Korea, in Japan, and in Asia. This is going to weigh on investor sentiment, particularly in Asia. And really the other solution, which would be China, is difficult to implement. The Chinese don't want instability. They don't want the Americans getting involved in that. They don't want to see regime change. But they also have to deal with a lot of other issues with the US, especially on trade. So they're not going to cooperate fully in a way that can really stop North Korea from advancing there. The second one, I would say, is Iran. Trump and a lot of people in his administration dislike the nuclear deal with Iran. There's good reasons to do that, but the truth is that that stabilized quite a bit the situation in the Middle East. We still think that, on balance, the deal survives, but there's a good chance that finally Trump decides to break that agreement. If that happens, the Iranians will push very aggressively to develop their nuclear capabilities as well, creating more instability on an already fairly unstable Middle East, with important implications, especially for the oil markets. And the final one, I would say, is relationships between the US and China. Clearly the two most important countries in the world, and the two most important countries for the world economy, for the metals, for markets. There's a big, absolute consensus in the US government that there have to be changes in that relationship. That China is not playing by the rules, that China is taking advantage of the US, and that a lot of the problems that the US economy has faced and that US voters have faced are a function of the way China works. But China is undergoing an important transition, politically, with a party Congress, and economically, as they try to move to engineer a soft landing, which they do seem to be likely to engineer. In that context, Prime Minister Xi cannot show any weakness, and there's not that much the US can do. I still think that cooler heads will prevail, and an all-out war, trade war between China and the US is unlikely, but we could see a tit for tat that could potentially escalate. So all those things, I think, are going to be very important to watch, and potentially will have important repercussions for the world economy. Now, what does that mean for Latin America and emerging markets? And I think this is very, very important for one simple reason. The real story, I think, in emerging markets and in Latin America in particular, is how governments are going to deal with lower economic growth. Now, I said in the beginning that the world economy was looking better, and that's true. But if you think about it, the real story in Latin America, as we experience, and you know it very well in the mining sector, a period of very high economic growth with remarkable political stability and social improvements in the past decade, driven by high commodity prices. Commodity prices have gone down, economies have slowed down, and those good old years for Latin American countries are not going to come back, or at least nobody thinks that they will come back. So governments are trying to find ways to rekindle growth, to find new engines of growth, and maintain macroeconomic stability in a more difficult environment. The trend that we're seeing throughout Latin America, which is a good trend for you, is essentially governments moving in a more moderate direction in macroeconomic and microeconomic policy, trying to create conditions for investment-led recoveries in infrastructure, in energy, in mining, in natural resources. And that trend is probably going to continue in most countries. You'll see governments that are more favorable to the private sector, that try to maintain macroeconomic stability, but also attract more investment. The problem is that the conditions are not really there, and that it's going to be very complicated to actually get there. And the conditions that I mean essentially are, the political conditions. And the reason is because what you have is weak governments. If you see the approval ratings of most presidents in the region, they're very low. The only president that is more or less doing well is Macri in Argentina, but the rest have approval ratings in the 20s, and very little expectation that they could recover. That's in part because of low growth, but that's also because of changes that electors have experienced. You've seen lots of people being lifted out of poverty and still have very high expectation that that is going to continue. You have new vulnerable middle classes that want to continue to have jobs, but that also want more services. And more services means more government spending and more government and state involvement. And the tolerance of those voters for corruption, for inefficient services, for lack of response is much lower. And it's going to be particularly important over the next year or so in Latin America because we're entering a very heavy electoral cycle. There's going to be elections in Argentina, in Chile, in Colombia, in Mexico, in Brazil, maybe in Venezuela, who knows. But the fact of the matter is that these elections are going to shape the fate of what happens in Latin America. I think that in most countries, we'll continue to see a move towards moderation. Colombia and Mexico potentially being the exception, moving to the left. But overall, I think what we'll see is a very mixed environment in which you have governments trying to make some of these adjustments, trying to implement policies that are more favorable for investors. In that sense, governments that are going to be much more receptive to industry needs. And I think, again, as I said, natural resources and energy are going to be particular sectors where an infrastructure where there was less investment and there's going to be much more interest, but with much limited room to do so than in the past. And in Peru, where you don't have elections, at least not presidential elections in the horizon, maybe congressional elections, but I let other people talk about that, but that seems still unlikely. These trends are also going to continue. Here you have a government that has a very clear orientation to try to attract investment, that has a good plan to do so, but voters that are increasingly demanding different things, and that put some limits in terms of social opposition to projects, in terms of higher environmental standards, and in terms of more demands on spending that are going to be really unbalanced. And so, just to conclude and summarizing a little bit of my views, I think when you think about the global picture, on balance, things are probably going to stay okay, but the risks are much higher than in the past, mostly because of the structural transformations that we have in the world economy and because of the leaders that are managing that transition, and that could very much derail the economic recovery. And I would say that also because some of the undercurrents that are driving change, especially in developed markets, and that is voter discontent with globalization and with the establishment, that's not going to go away. Even if the economy recovers, and we see it very clearly in the US, and even if unemployment is low, there's broad sectors of the electorate that are being left out. The losers of globalization and of trade are not being integrated. And those people will continue to be angry and will continue to vote for governments that are angry. In Europe, not as much anymore. We seem to be out of the woods with the election of Macron in France and Merkel probably doing well this weekend in Germany. But those undercurrents are still going to be there. The same is going to be in the US. And I think those undercurrents are also going to be important in shaping politics in all of our countries in Latin America. The anger that you see today, and again, I think that's really what unites all of Latin America today, that voters are angry with governments. Today they are angry with governments because of economic growth, because of corruption. It's not like in developed markets where it's against trade and against the establishment. But governments don't really have a lot of room to deliver on those demands. In terms of growth, they can try to attract investment, but it's not going to be easy. In terms of corruption, well, that's very hard to actually solve. In terms of providing more and better services, that's very difficult to do at a time where they're fiscally more constrained. But also, the same anger that you have in developed markets eventually will start to get to Latin America. We're still in this weird situation where the people that benefited, where most people benefited from globalization. High commodity prices led to low unemployment, to reduction in poverty. But if those years don't come back, we're going to start to see the impact of technology, of negative impact of technology, the negative impact of trade being felt more acutely, and that potentially being a source of instability. So at least for the region, I think you potentially have a better operating environment from the macro perspective in terms of what governments are trying to do, but a much more difficult micro operating environment in terms of what voters want and what communities want. And so with that, let me stop, and thank you very much for your attention.
Bien, muchas gracias a Daniel por esta estupenda presentación. Daniel viene, por lo menos yo lo conozco desde que cubría acá en el Perú y veía lo que pasaba en el año 2006, las elecciones. Y es un atento seguidor de las cosas que pasan no solo en la región, sino en el Perú. Acá te veía como Dan, no te conocía como Daniel, te conozco siempre. Vamos ahora con la presentación del señor Richard Wilson, quien es Chairman of Metals de Wood Mackenzie Limited del Reino Unido. Por favor.
Well, good morning, ladies and gentlemen, distinguished guests. Firstly, I would like to thank the organizers of PERUMIN to having invited me back again to speak on behalf of Wood Mackenzie in terms of our views on the outlook for the metal markets. For those of you who are unfamiliar of Brook Hunt, of Wood Mackenzie, I would say that we provide market intelligence and strategic analysis for governments, for banks, producers, consumers, et al. We have a global presence in most of the major markets, offices, and we have had representation here in Peru for the past 30 years. Now, the first chart I've put up, and I make some apology to members of the audience who know these figures very well. I think they actually make a very sound point. What we can see here is the export value of commodities in Peru, and we can see that since 2015, investments in the likes of Las Bambas, Cerro Verde expansion, and the like, and we can see that copper is now 50% of all metal exports in Peru, and indeed around 30% of total exports. So copper is the dominant metal here in terms of what we are seeing. And if we look at recent price action, I've taken some selected metals and I've indexed them relative to 2011. We can see that both zinc and lead have performed exceedingly strongly. This is partly on account of reserve depletion at some major mines in places like Australia, and it's also due to strategic curtailments made by large companies like Glencore in order to get these markets back into rapid balance. Copper has come late to the party. It only started to recover late in 2016, and this was on account of Trump's proposed investment pump, a higher than expected Chinese demand, and some disruptions in the copper mining industry. Gold and silver have not performed as well, although in recent months we've certainly seen some interest in both of those commodities. I think it's very important to point out at this point that the recent price activity we've seen in these markets since the middle of the year is more speculative than fundamental. And that's an important point because I think it means that we might actually see softening prices as we move into the fourth quarter. If we look at the open interest in the various exchange markets on the left-hand side, we can see the commitment to traders report for COMEX. You can see a very substantial long position has been built up on the COMEX market. Over on the right-hand side, if we look at the Shanghai Futures Exchange, you can see two things have happened recently. We've seen the build-up of long positions as prices were rising, and more recently, we interpret the actual closeout of short positions. So this, again, really does point to the fact that there's a lot of speculative money pouring into not just copper, but into many of the other commodities. I put this chart up because I think it shows something really interesting. If you look at the dark blue bar, you can see countries like Peru, Chile, Australia, Canada, the commodity producing countries. And if you cast your mind back to 2010, you can see just how significant the contribution to global GDP has come from commodity producers. Now, of course, post-2011, we saw commodity prices, mined commodity prices declining, and that had really started to pinch out GDP. And then in 2014, a lot of the energy markets collapsed. And this is why you see such a very small contribution in 2016 from those commodity-producing countries. Now, the good news is we're starting to see a recovery. And this is good for the global economy because we're now looking at sort of growth rates in GDP of around 2.7% in the short, medium term. And despite all the talk being about growth has really declined in China, we can see that both in terms of copper consumption over the next 6 years and in terms of slab zinc consumption, the contribution story is still China. 1.7 million tons of incremental growth in China in the copper market is about 55% of the entire incremental growth through 2022. In the case of zinc, 1.4 million tons of incremental growth is nearly 70% of all incremental growth in the zinc market. Now, we shouldn't get too hung up about growth rates. We all know that Chinese growth is declining. The importance, though, is at the same time, the size of the Chinese market is growing very, very rapidly. Let's look at the years 2000 to 2004. What we can see in that time period, slab zinc consumption growth was 15% per annum. If we translate that into tonnage terms, that was a growth of 240,000 tons every year. In the current period, 2015 to 2019, shock horror, growth rates are now only 3%. But if we look at that in absolute tonnage terms, we're still growing at 230,000 tons of demand every year. You'd have to build an Antamina zinc mine every year to satisfy the current demand, even at 3% growth. Now, the one thing that I think is important to recognize, copper mines rarely meet their guidance targets. You can see from the chart on the left-hand side there, all manner of disruptive elements come into the copper mining industry. So we have, for example, pit wall failures, we have strikes, as we saw in Chile earlier this year, we have technical problems, SAG mill failures, and slow ramp-up of projects. We typically see 5% of initial production expectations lost due to disruptive elements. And that's equivalent to the loss of about 1 million tons a year of mined copper production. Just recently in zinc, as I mentioned earlier, we have seen the closure of significant operations on account of reserve exhaustion. But in addition, Glencore elected to take some strategic curtailments and took around 435,000 tons out of the market. The sum effect of this is the zinc market has lost around 1.1 million tons of mine production in the last couple of years, and this has very dramatically changed the outlook for zinc. Now, one of the reasons why these markets are so difficult to balance is that you have a very long lead time to bring mine projects into production. These are the various mines that have been brought on in recent years. The left-hand side refers to copper projects, the right-hand side refers to zinc projects. And the importance here is that, typically for a large project, you're thinking in terms of around at least 5 years to bring a project into production. The problem is that the demand cycle is typically on a much shorter scale. And so what we have seen is that big investments into mine projects have come after the peak in metal prices. And this is what accounts in these markets for the boom-bust or the feast and famine effect that we see. Now, this is a very, very important slide because both the copper market and the zinc market have the same challenges. What we can see here is that demand is growing at a sort of reasonable rate, nothing spectacular, but actually it doesn't have to grow at a spectacular rate. The one thing that characterizes both of these markets is reserve degradation, attrition of ore grades, falling ore grades in both the copper supply market in mines and in the zinc market. And what this means is that both of these industries are having to run very fast just to stand still. And we see potentially a very large supply gap growing in both markets over the next 10 years. Now, Peru is extremely blessed in the sense that it has millions of tons of metals in the ground in the form of reserves and resources. But it seems to me that in order to get these reserves into the market, it's essential for the Peruvian society as a whole that we have a three-way agreement between the mines, government, and communities. Mining has changed substantially since the bad old days. And I think environmental best practice is something that the mining industry needs to really educate communities with. Government has its role too. Government has to educate also communities of the benefits, both direct and indirect, that mining brings to a country like Peru. Also, I think it's important that government manages the expectations of communities. This is a very important point to understand that it's not an open checkbook, and mines have to show a certain rate of return at the same time. So this is very, very, very important. The last point I want to make about this slide is supply gaps shut in one of two ways. Either supply rises to meet demand, or demand is destroyed through substitution to meet supply. I hear an awful lot in recent months on my travels about copper mining companies in particular rubbing their hands together saying, oh, electric vehicles, this is a wonderful new market. What I'm not hearing from the mining companies is who's going to be building the mines to supply these incremental demand characteristics of the markets. What is the issue? What is holding back mining companies from developing new projects? I think value destruction is something that is a lesson that a lot of the new wave of CEOs have learned from the past. There is extreme reluctance to invest billions of dollars into projects only to actually miss the next upcycle in prices. So that's a very important point. Also, balance sheets are improving very fast at the present time, but there is no investor appetite for investment in mega projects. Dividends are really what the mantra of the shareholders are talking about. New projects are also not as good quality, if you like, as existing operations, and you actually need to spend more money to achieve larger scale to get the benefits of economies of scale. And of course, many of the good projects that are out there are in the hands of companies that don't want to actually invest them at the present time. And here we can see that the light blue line is the annual average copper price. We can see in 2010, the second half, confidence came back to the mining industry post-GFC. 3 million tons of copper projects were committed to in 2010. What we can see here is a massive increase in capital expenditure in new projects. The copper price peaks in 2011. Guess what? The capital expenditure carries on for 3 to 4 years. And this is why mining companies are being accused of value destruction. It's all about timing. And as a consequence, we can see this is the copper mining industry on average. The bars are a stack of costs, mining costs, processing costs, things like sustaining capex and expansion capex, and the red line are the net revenues. And you can see just how terrible the residual cash flow has been for the industry since 2013, culminating in barely 20 cents a pound pre-tax. Remember that the mining industry has to not only fill its balance sheet up, but it's also got to pay tax and, importantly, keep shareholders happy. And this has been a real problem for the industry. This chart shows the FTSE 100 index. That's the dark blue line at the top. And the shaded area are mining companies that are on the London Stock Exchange in this index. The top of the line shows the best performer. The bottom of the shaded area shows the worst performer. And you can see the value of shares in the mining sector went into free fall post-2011. By 2016, the worst performing mine lost 90% of its share value. The best performing mine lost 60% of its share value. So this is one of the major reasons why mining companies are so acutely aware that they have to be competing with other asset classes by paying the dividends and not making the big spends. And I think the real issue is that I think built into copper and zinc's DNA today, I think prices inevitably are going to rise on a 5-year time horizon. Only something like a global financial crisis or some similar macro shock can stop this. Aluminium, by the same token, which is the dark blue line there is an abundance of aluminium supply. You don't have a supply gap in aluminium. The aluminium market is 10 million tons oversupplied. So as copper prices go into the next upcycle, the differential between aluminium prices and copper prices will get to a point where substitution once again comes to the fore. So the copper mining industry, on the one hand, it's going to benefit from higher prices, almost inevitably, as will the zinc mining industry. But we have to be careful, because if we don't supply new operations, substitution is going to destroy some of these end-use markets. Just touching very quickly on gold. Gold is another important contributor to Peruvian exports. What we've seen is we believe that actually mine production will either have peaked in 2016 or almost certainly in 2017. We will only know at the end of the year. But moving forward, reserve attrition because of mine plan adjustments has really seen production will start to come off with the price-related cuts that we have. And many of the major producers are now focusing on value over volume. If we look at the 10 major gold-producing companies in the world, over the next 5 years, 5 of them will see lower gold production according to their guidance than we have today. And despite robust free cash flow, a number of operations remain reluctant to develop projects alone. So to sort of wrap up, what do we think about copper? As I mentioned, current prices considerably above what we saw in the first half, and we believe that we start to see prices falling back by the fourth quarter. Not dramatically, and we have a price forecast of just under $2.70 a pound. Moving next year, we do still have mines coming through. Escondida's third mill will be ramping up to full production. We have Cobre Panama just coming along. We've got the Spence sulfide project. Toquepala here in Peru is doubling production. Glencore are reactivating African operations. So we're not starting to see that supply gap opening, but again, we see prices moderating up quite nicely, and it's really sort of from that 2020 period where reserve depletion is going to have a major impact for copper producers, and we see prices rising very substantially. We're looking at that sort of 2020 to 22 period of around $3.45. If we look at zinc we believe will respond quicker than copper. We see mine production cuts have had a very dramatic effect on concentrate availability and now metal availability, squeezing the market. Next year, a lot will depend on whether Glencore reactivates its mines or not, but we see some very, very strong zinc prices into 2018 and 2019 and moderating somewhat thereafter. And then finally for gold, well, gold's had a very mixed start. If we look at the World Gold Council's information that's been released recently, we can see that ETF demand this year is down by 71%. In terms of jewelry demand, India has really propped up that market this year with growth of 33%. The rest, the world as a whole has only grown by 5%. And overall demand is down by 14%. We have a lot of speculative pushing and pulling in the market. The price outlook does appear conflicted. On the one hand, we've got risk on, risk off with issues with North Korea. A weaker US dollar is certainly positive for gold prices. We also have central banks now unwinding their unconventional policies. So as that happens, that also has a negative impact. Next year, we have the spectre of rising interest rates in the US and elsewhere, further unwinding of these, or normalization of the policies by central banks, and an ongoing depreciation of the US dollar, which will be helpful. So we're looking at prices ranging around $12.15 to $1,250 an ounce. And then moving forward, I think supply starts to move in as a major consideration. Mine output growth will be difficult to maintain at the sort of levels we have seen in recent years. And I think the other thing is that we would anticipate lower peak in US interest rates in this current cycle, which again will be positive for gold. So on balance, copper, zinc looking really good. Gold has a good future. So from a Peruvian context, I think this is very good news. And with that, I will thank you and close. Are you next?
Muchas gracias al señor Richard Wilson, y vamos ahora con la presentación del señor John Willett, quien es Managing Director de Investment Banking Raymond James Limited.
I'm not quite as good at walking around on the stage and talking as my two distinguished colleagues are, so I'm going to stand in the podium where I can hold on to something. Well, thanks very much for inviting me to speak today, just to talk a little bit about what capital markets, and I think to kind of give a little bit of a perspective about what's going on in the capital markets in North America and to some extent in other parts of the world. I'm based in Toronto, and from that location, I work on the investment banking side, and we deal with miners both in North America, South America, including Peru, as well as Australia, and all the other parts of the world. But I'm going to just do a quick overview of what's going on, primarily focused on TSX and some of the statistics there, but they are reflective of what's going on more globally. So just by way of background, I work for Raymond James, which is a US-based investment bank established in 1962. Mining investment banking and research is based out of Canada. And we have a total of 35 bankers here. We're one of the larger retail networks in Canada and in the US, with distribution, as you can see, across Canada, the US, as well as a presence in Europe as well. And we have a large mining team, including 4 dedicated equity research analysts, as well as a banking team and equity capital markets team. There's just our analysts by name, all of whom have technical backgrounds, and many of whom have worked for some larger global banks, and some of the companies that we have under coverage are down the bottom there. So we are involved with a lot of transactions, both M&A and financings, and those are listed there just to kind of give you a little bit of a taste for the kind of things that we're involved with. And in terms of things that we've done in Peru, you can see the companies that we cover from a research perspective, and the operations that are based in Peru, as well as some of the companies that we've financed and advised over the years on the investment banking side. So talking about, I've broken up the talk into 2 parts, first being the precious metals, and then a little bit on the base metal side. I mean, overall the theme from a equity perspective has been that there's been, and an M&A perspective, is that there's been very little done in terms of equity financing in the base metals market. So there's that part of my presentation is going to be relatively limited, and I think the kind of factors that Richard was talking about in the last presentation have had a big impact on that, as particularly on the base metals side, as base metals fell out of bed and declined significantly. A lot of the companies and have been cutting back on, well, they've had to manage balance sheets, and they've had to manage production because as commodity prices have gone down, they've had to manage costs down as well. So that's had everybody retreating into their bunkers, and investors have not been enamored. You know, I thought Richard's comments about the worst performer going down 90% since 2011 is very, I think, telling of kind of why investors have not been interested in base metals particularly, and there has not been that much interest in gold as well. The next slide here, just to kind of give you an idea about what's been happening more recently, we've seen, you can see the gold price in yellow, and you can see the HUI divided by the spot gold price below. And as we move towards the latter part, or the middle part of this year, you've seen equities diverging from the gold price. So even though gold prices have been going up, the equities have continued to languish for a variety of reasons. You can see down the bottom left just what's happened in terms of the performance of the equities. It hasn't been spectacular. Junior producers down 28%, even senior producers are still flat to down, while gold price has risen somewhat. And if you look going forward, nobody has a spike up in the gold price over the next number of years, despite the fact that we're now kind of in the 1350 range. Nobody's forecasting huge spikes up in gold price. So a flat to stable environment, I guess, somewhat along the lines of what Richard has been talking about. How has that affected mining equity financings? Well, you can take a look at this chart. On the top, you can see the amount of financing. This is in billions of dollars that's been raised over the last number of years, starting in 2009, a big surge after the GFC, and then basically has declined every year since then. And to date, we're on track for the lowest number and size of equity financings that we've seen since, it's been a long time, put it that way. It's not even on my chart. So, and similarly, if you look at the bottom side, you can see the equity financings by quarter. And again, they're almost microscopic here. There's almost no bar for the third quarter of 2017. Probably 3 or 4 financings have been done in July, August, and September. So a very anemic market. Here's just a chart that shows you what's happened year to date and who's come to the market. And you can see the large gap there as we went into the summer, and there's been a few financings that have happened this fall, but basically most of them are tax incentivized products specific to Canada, and likely otherwise these companies would not be able to raise money. This is an interesting chart for our clients that just shows you what's happening with the size of the discounts that you have to take in order to get a financing done, as well as how how the size of the financing relates to the overall market cap of the company. And you can see the average discount is about 8%, and the median size of a transaction is about 8.8% of market cap. But the interesting thing embedded within this chart is also, you'll see that there are, as the waves of financing come, some of the earlier financings manage to get lower discounts, but there's very limited money available. So in order to incentivize investors to make that next investment and subscribe to that next financing, you see the discounts continue to rise in order to attract investments. And there's a few financings here on the left-hand side where there was a disastrous outcome where the financing had to be repriced down almost 20% from the market price at the time the deal was announced in order to complete the transaction. Just taking a look at where the demand has come from for these financings, there has been a move towards more interest and involvement by Canadian institutions more recently. If I'd shown you this chart in 2016, you would have seen a lot more UK funds, BlackRock, M&G, and groups like that were much more involved. Carmignac were making some big investments. But now we're starting to see the Canadian funds come back into the fray, as well as obviously some significant US funds. I take that as an encouraging sign, because a lot the Canadian investors are very knowledgeable and very technical in terms of their analysis, and when we start to see them getting involved, I think it's a good sign that we should see additional demand going forward. One of the other themes that's been happening in the market that's quite interesting is that perhaps because there has been very little money raised from an equity perspective over the last 5-6 years, and because there are a lack of new projects available in the marketplace, we've seen a lot of the larger companies making investments into some of the explorers and smaller developers. And this is just a cross-section of the ones that have happened since the middle of 2015. You can see some of what the type of the offering was, and what kind of benefits the investor got as a result of being involved in the transaction. For instance, in a lot of cases, the companies have put up 9 or 10%, own 9 or 10% of the stock, and they have the ability to maintain that interest going forward. In some cases, they have a right of first refusal to participate. They get board representation. So it's been a way for some of the larger companies to get exposure to earlier stage projects. Interestingly, this has not led to M&A, and in a lot of cases, even if a company has made the investment, made an equity investment in the company, that does not necessarily mean that the company will be acquired by the group that has that stake in the company. And you can see, in some cases, it's worked out Integra, which is a transaction that we advised on. It was around a $600 million transaction. Was acquired by Eldorado after they had made an equity investment in the company about 2 years ago. But in other cases, as an example, Probe Mines Agnico made an investment in Probe, but ultimately Goldcorp acquired that company. So it's been a mixed bag as to whether equity has ultimately allowed or put you in a better position as a larger company to acquire it. So just wanted to kind of give you a sense of how the equities are being valued currently. So this is sourced from Raymond James Research as well as consensus estimates. And you can see silver companies still maintaining the highest multiples, maybe partly because of the fact that there are a limited number of them. They've continued to perform well on a price to NAV as well as on a price to cash flow basis. And then, as you'd expect, the multiples are coming down as you move from left to right there, with the senior producers that have lower risk still getting higher multiples versus the developers that are out in the markets, that are particularly the ones that are still unfinanced. So these valuations, as you can see, do lead to an environment that should stimulate more M&A activity, since valuations are much higher for the seniors and the intermediates than they are for the juniors or for the developers. So we would expect in a kind of perfect world to see more M&A. And on the next slide, you can see what's happened kind of since the beginning of 2016. These are most of the transactions that are over over 50 million in size. And you can see at the very beginning there were a number of acquisitions of producers, and as the market continued to move along, those acquisitions have moved into to the development stage. And up in the top right there, you can see that in 2015, 70% of the acquisitions would have been acquiring producers and assets from producers, and that has now flipped around so that 60% of the acquisitions are now of development stage projects. The problem is that there are getting to be less and less of those development stage projects to buy. So just in terms of the gold market, I won't try to go to make predictions. Richard, I think, has already done that, but we are kind of predicting a little bit stronger gold price in the second part of this year. And for 2018 onwards, we continue to use $1,300 as a flat price, since we expect that the grades are continuing to decline, and all-in sustaining costs you need around $1,300 for guys to make money and incentivize new mine construction. So just moving on to briefly talk about base metals, and as I mentioned, there's really not as much to say on this. The market has been terrible, I think would probably be a charitable way to characterize it, but you can see here what's happened to the indexes and the large cap and mid cap and small and developers. As a result of that, the commodity prices have in the last 12 months have improved since basically since Trump came in particular, and with copper being the best producer and zinc being the second one. So I think we echo the themes that Richard was talking about earlier, and you can see our consensus prices going forward for zinc and copper, with obviously a long-term positive outlook for copper in particular, with a good strong performance out of zinc here over 2017, the balance of this year, as well as 2018 and 2019. So here's the market for base metals financing. Just to note, there was Freeport did a couple of large at the market issuances, which are not included in this, so it skews it a bit. But more generally, what we can see is that markets fell off a cliff here in 2016 with very little done, and now we're starting to see a surge upwards here as the interest in the base metal starts to return. And I thought this was an interesting slide just to kind of show you what's happened to the multiples between last year and this year, just to give you a sense of what the valuations are looking like. So on the left, you've got the 2018, and then you're looking at the 2017 number. And as you can see, on the top, we look at the basically enterprise to EBITDA multiples, and basically they've come down a bit as cash flows, as stronger prices have increased cash flow. But interestingly, price to NAV in particular have really started to go up. So a year ago, stocks were trading at, even the global diversifieds were trading at 0.6 times NAV, and recent performance has moved that up to about 1 times, which is much closer to the historical averages. And in the meantime, down on the bottom right, you can see that the balance sheets are starting to get addressed here, where net debt to EBITDA has decreased significantly for all these companies across the board, whether you're the global diversified or a small mid-cap. The balance sheets are starting to work, and that's getting people back in the frame of mind of making new construction decisions and doing more equity financing as valuations improve. Our preferred commodities would be similar to Richard's. We're looking at, we view copper and zinc as being the primary commodities that you want to be involved with. And kind of similarly to what Richard was saying earlier, we see supply-demand deficits for copper, and similarly for zinc. Perhaps not as much as you would expect in 2019 and 2020, but looking very strong here through 2017 and 2018. So key takeaways from precious metal has been quite modest because of a stable gold price and a lack of new money flowing into investment funds. So that's limited the amount of demand. There have been new equity issuances for both gold and for base metals, but it remains very selective. A lot of what we hear is institutional fund managers saying, I don't have any new inflows of money. If I want to buy a new equity issue, I have to sell something else. So it leads to a situation where people are being selective. On the M&A side, we expect expect M&A to continue, particularly on the gold side. None of the major gold companies have spent money on exploration over the last 5 years, and that's resulted in a very limited pipeline of new projects for these guys. And so they're going to be looking for those. Most of the exploration that's been going on a lot of it's been in Canada, and as a result, we've seen a lot of Canadian projects kind of at the development stage that we would expect to be acquired by larger companies here over the next couple of years. Again, on the same theme, because there's no new projects, the majors will continue to make equity investments into the developers and increasingly into the exploration companies. We prefer commodity in the copper and zinc commodities, with the zinc peaking next year and copper in 2018. And we expect the base metals companies to continue to delever through cash that they're now generating from operations, as well as we see a more robust equity market for base metals developing. And with that, I'll finish it off and defer to our next speaker. Thank you very much for your time.
Esta presentación tan interesante. Tenemos exactamente 15 minutos para poder conversar con los integrantes acá del panel. Y si me permiten, me parece muy interesante lo que plantea la ministra Cooper en términos de expectativas y todo lo que puede generarse. La pregunta que le haría es, en el primer año, digamos que el propósito era el mismo y las cosas no salieron tan bien. ¿Por qué van a salir bien ahora en el segundo año?
En primer lugar, porque yo creo que hemos aprendido. Cuando uno se sienta un equipo nuevo en cualquier parte, empieza a entender cómo funciona el tema. Y entonces nos hemos dado cuenta de los problemas que habían, que de alguna manera no los miramos bien, que fue el caso, obviamente, del enredo institucional que hubo con muchos de los proyectos que se habían adjudicado, que era básicamente el tema del destrave de proyectos. Y cuando relanzamos el sistema de inversión pública, fue un sistema que de alguna manera nos lo torpedió el tema de la corrupción, porque claramente hace mucho más difícil la aprobación de proyectos si estamos en un entorno de sospecha colectiva. Esas cosas se han disipado y por otro lado hemos empezado a ajustar, ¿no es cierto?, la reforma con las normativas, las hemos ido mejorando en el tiempo y ya vemos que ahorita ya empezó a correr. Ya vemos un sistema de inversión pública que empieza a dar sus frutos, vemos una proinversión que ya va a adjudicar casi 3.500 millones, porque lo que hemos hecho nos ha demorado agilizar el tubo mucho más de lo que creímos originalmente. Entonces nos hemos dado cuenta que tenemos que dar el dinero a quien que ejecuta rápido y bien y que además tenemos que interconectarnos mucho mejor. Esa interconexión entre entidades públicas se ha logrado a través de ajustar, ¿no es cierto?, la reforma con ir ajustando nuestras normas, ir ajustando nuestros equipos para que eso fluya mucho más rápidamente.
Su presentación, ministra, le da prioridad a lo que es el destrave de proyectos en el sector público. En cuanto al sector privado, ¿qué cosa puede cambiar para alinear mejor, y pensando en el sector minero en particular, estas coordinaciones intersectoriales que se requieren, no solo el Ministerio de Energía y Minas, sino el Ministerio de Economía, o el de Agricultura, o a veces el Ministerio del Interior, digamos? ¿Cómo el gobierno se va a coordinar en su conjunto para poder facilitar y destrabar inversiones en el sector privado, minero en particular, que están con tanto tiempo aguantadas, retrasadas?
Ahora, yo creo que como cualquier equipo humano nos hemos empezado a engranar mucho mejor, todos los sectores. Lo que ya tenemos es una coordinación casi diaria, ¿no es cierto?, con los diferentes sectores para lograr que los proyectos salgan. Nuestro foco es destrabar, pero también que los nuevos proyectos salgan más rápido, basados básicamente en una mejor priorización de esos proyectos. Aquellos proyectos que ya están listos para salir, salgan más rápido. Entonces, hemos articulado mucho mejor porque es un equipo que se va afianzando, ¿no es cierto?, que se ha ido afianzando en el tiempo, que ya coordinamos casi diariamente. Segundo, hemos hecho mejoras de las normas. Y en el destrave de proyectos, lo que nos hemos dado cuenta, hemos aprendido de qué cosa era lo que de alguna manera no vimos y que ahora ya vemos, ¿no?
Daniel, quisiera preguntarle, Daniel trabaja en el seguimiento de las tendencias políticas, económicas, sociales, Daniel trabaja en la región particularmente. Para un país como el Perú, para la minería, pero para el Perú en general, ¿cuáles percibes que son los principales riesgos de los próximos 2 años?
Yo creo que el principal riesgo es un poco algo que ya se habló, que es la implementación, que vemos en otros países también, ¿no? Es gobiernos nuevos que traen buenas ideas, a lo mejor buenos diagnósticos, pero que tienden que el proceso es difícil. Y creo que algo interesante que mencionó la ministra es que también es algo que hemos visto en otros países, evidentemente ve que las expectativas del sector privado llevan tiempo hasta que siguen al sector público. Y creo que en ese sentido aumentar la inversión pública es una buena idea. Por ejemplo, si uno mira lo que pasa en Argentina o inclusive lo que pasó en México, es que el sector privado necesita a veces que se lo empuje. Yo creo que mirando hacia adelante, sobre todo pensando en Perú y comparando a lo mejor con otras regiones, creo que el tema institucional social va a ser el más difícil, ¿no? Es evidente que hay los fundamentos macroeconómicos de Perú son muy sólidos, el entorno global es bueno, pero el tema de manejar las protestas sociales, las oposiciones de las comunidades, es algo que ha venido afectando inversiones a lo largo del tiempo y creo que es algo más difícil que solamente tener un plan, porque requiere a lo mejor cambios institucionales más fuertes. Yo creo que hoy, pensando hacia adelante, sobre todo Perú, pienso que ahí está el principal desafío.
Quisiera plantearle para los señores Wilson y Willett la misma pregunta. ¿Cuáles son los principales riesgos y oportunidades, de manera muy resumida, que tiene la minería peruana en los siguientes 2 años? Which are the main opportunities and risks facing the Peruvian mining sector in the next couple of years?
When I look across the world, it's quite clear that Peru is in a very unique position. You have a country that has several dozen projects that are awaiting development, but there are hurdles. Peru is blessed with very low labor costs. We saw the minister's remarks about energy. So many of the building blocks here are just ready and waiting to have these projects come in. I think the main issues remain the social hurdles. Now, clearly, government is very well aware of these hurdles, but I think it's the execution of educating the communities and bringing them on board with these new projects that really is going to be the real risk to whether or not Peru participates fully in closing these supply gaps I was talking about earlier or not.
Mr. Willett?
Yeah, I think from the capital markets perspective, some of the challenges, are the fact that companies have not had real returns on equity and returns on capital. That makes sense. Return on capital invested has been very poor in the mining sector historically, and that's disappointed a lot of investors. So part of the challenge is for the companies themselves to propose projects that make better economic sense and are returning more value for shareholders. And that's nothing specific to Peru, but rather to the whole industry. And and I guess further to that, the investors don't have a lot of capital to put into these new projects, and they need to be convinced that they see a sustainable commodity price, so that they can make those investments with the assurance of a return. So neither of those are particular to Peru. As Richard just said, the projects that Peru has are outstanding, very good projects, and I think a lot of people are very positive about Peru as a place to invest, notwithstanding some of the social issues that we've seen in the past. And I think there's a lot of enthusiasm to see those projects go forward.
Muchas gracias. Y volvería con la ministra. Usualmente lo que se escucha siempre en los medios, en muchos lados, son los reclamos del sector empresarial al gobierno. ¿Usted le podría decir algo a los CEOs y a los ejecutivos principales de las empresas mineras en este caso? ¿Qué mensaje les daría de qué espera el gobierno que hagan? ¿Cómo mejorar coordinaciones para poder avanzar? ¿Qué les quisiera decir?
A ver, yo creo que la coordinación entre el sector público y privado es lo clave. En la medida en que nos acerquemos unos a otros, vamos a empezar a ganar confianza, porque en realidad el sector público no es solo el MEF, el sector público es el MEF, las regiones y los sectores. Normalmente la relación con el MEF siempre ha sido muy fluida, tenemos que hacer un esfuerzo, ¿no es cierto?, por coordinar todos mejor. Yo toda la vida que he estado en el sector público me he dado cuenta que el mayor conocimiento está de quien está en la cancha, que es quien nos tiene que informar cuáles son sus problemas. Y en la medida de que eso sea solucionable, porque hay consenso para eso, se va a tratar de coordinar, ¿no? La idea es que apuesten y que en realidad tengan, se genere esa confianza público-privada, que es la que yo creo que es clave, y que tiene que trascender el MEF, porque el MEF siempre ha sido de alguna manera la isla, en su objetivo de generar crecimiento y de mantener la economía, ha sido el sector que más relación ha tenido con el sector empresarial. Hay que acercarse no solamente al Ministerio de Economía, sino al resto de los sectores y sobre todo a los gobiernos subnacionales, que es donde está la principal inversión minera, ¿no?
¿Y qué es lo que están pensando en el gobierno para el trabajo que concierne no solo en la empresa privada, sino en el terreno social? Daniel hacía mención que ahí está uno de los principales obstáculos para poder seguir avanzando en cómo manejar la conflictividad social. Entiendo que ha renunciado el viceministro de Gobernanza y que veía estos temas en la presidencia del Consejo de Ministros. ¿Cómo se apuntala el gobierno para esto que viene, para esta fase, para estos siguientes 2 años, donde el tema de conflictividad social puede volverse un problema que obstaculice y paralice muchos proyectos de inversión?
En el tema de conflictividad social nosotros queremos ser un equipo como Estado, ¿no? Al MEF lo que le toca es un poco lo que ya hice en mi presentación, es asegurarme de que a través de la inversión pública la población pueda gozar, ¿no es cierto?, de los beneficios de esa inversión. Por lo demás funcionamos como equipo, cada entidad del Estado tiene su rol, y lo que estamos haciendo, y como yo decía al inicio, es un equipo que se va afiatando y que en realidad entre todos, Ministerio de Energía, Ministerio del Ambiente, PCM, etcétera, estamos coordinando todo el tiempo para conseguir, ¿no es cierto?, que eso se dé. Como dijo, yo puedo hablar por el caso nuestro es articular las necesidades que los demás sectores nos dicen para asegurarnos que esos proyectos estén hechos a tiempo y bien, y que les permita a la población saber que gozar de los beneficios y no tener que esperar los 8 años a que llegue la plata, ¿no?
Y otro espacio de conflictividad no social, pero política, ha sido el Parlamento. ¿Qué es lo que están pensando? ¿Cómo hacer para que en este espíritu que se ha creado esta semana con el nuevo gabinete, donde todo es maravilloso y todo ha cambiado y hay una reacción de la oposición tan interesante, cómo afinar mejor las relaciones, ya no pensando en la macropolítica, sino en los proyectos, etcétera, de cómo mejorar las coordinaciones con el Congreso para poder conversar de proyectos específicos?
Mira, por el momento nosotros estamos enfocados en que nuestro plan funcione, ¿no? En hacer el crecimiento y la inversión los ejes del crecimiento. Yo creo que el tema político es algo que, como digo, nosotros lo que estamos buscando es funcionar como equipo y que cada uno haga el trabajo que le corresponde de la mejor manera posible.
Ministra, ¿algo más que quisiera agregar?
No, más bien, muchas gracias por haber estado acá.
Bien, entonces así las cosas, pues solamente queda agradecerles a los 4 participantes, a la ministra Cooper, a Daniel Kerner, a Richard Wilson y a John Willett por sus estupendas presentaciones y decirles que los anuncios de rigor, pues los invitamos a un receso de café. La siguiente sesión empieza a las 11:30 en punto acá y les agradecemos devolver los audífonos. Muchas gracias a todos.